All right, so I just want to throw out again a shout out, please. If you haven't registered for the spring, please do so. If you haven't registered for fall 2 and you feel like you do want to register for fall 2, there's still time. The fall 2 semester only starts, I think it's on January the 3rd. So you have time until then, but remember the whole vaccination complication is in there, in the sense that I think to be able to participate in classes for fall 2, I think December 11 is when you have to be vaccinating yourself if you haven't done that, if you're going to do in person or hybrid. And then for the spring, you have to be fully vaccinated by, I think Jahome, was it you who said February the 23rd was your birthday, so you remembered this date. I might be mistaken, sorry if I am, but I think we said February the 23rd, people have to be fully vaccinated for the classes that start in March. So please register if you still have classes to take. I'm looking at some of my class numbers, they're okay, but some other people have said, the enrollment is low, which means that for those who are already registered, we run that risk, which is always terrible, that a class could be canceled because enough people aren't enrolled, and then people wake up last minute and suddenly want to register, and then the class was already canceled, and I mean it's there's just so many knock-on effects when the classes are not fully subscribed. So if you have questions about registration, if you're in a class and you want to take the next class and it's a business thing and you're being blocked from taking it, talk to me, because we can override these things for whatever reason. Like if you're an accounting major and you need to register for intermediate accounting 1 after this, but it's not allowing you to register for it because of the fact that you haven't finished principles of accounting 2, just talk to me. I can get the department to help you to register so that your name is in there, and we can make sure that you have a place, a seat in the class, especially if you want to take it in fall 2. All right, so register. That's a big deal. Today we're here on the last piece of chapter 18, and then next week Tuesday is the last day. Sad face. I'm sure nobody has a sad face. You're probably so relieved to be rid of me, but like next week Tuesday.
No, that's not true, Professor. It's hard, but it was still a great class.
Okay, I'm glad to hear that the torture is balanced, right, with some fun and some learning. But next week is the last day, so your classmate C, I thought they had a great idea. She said, is it possible to go over some of the questions that are in the final exam review that's on Wiley that I gave to you guys, to go over that as part of the prep. And I was going to prepare questions to go over anyway. So I think that that's great, because that's a twofer, as they say in America, right? 2 birds with 1 stone. You end up reviewing for the exam, but I also basically end up walking you through the final exam review, which counts 2% of your grade for the class. If that's news to you, hopefully it's not news to you, but for some people it might be news. So I'm just going to remind you that this final review practice questions, it's out of 20, but I think it's only 4 or 5 questions. It's 2% of your grade, and I know it's a scramble here at the end. It's going crazy with everybody, I'm sure. So come on Tuesday, come ready to try to work through your questions. I know many of them are algorithmic, so my numbers will be different, but the process will be the same. I'm seeing something. Yeah, I don't know that it's 9 questions. Let me go into Wiley, and so I'm going to show you guys where this is so that you know what I'm talking about. Otherwise, people might be confused about what this means. So on Tuesday, you come, hopefully you have a computer and you're not doing this from your phone. You open up, and let me see. Oh, it's not available. Well, it's not available for, no, it is available for you guys. Yeah, the review. Okay, so we're going to work through this. I'll tell you everything that's on the final, then we'll work through the questions. All right. So what C was saying is right. It's 9 questions. Some of them are longer than others. Many of them are about bonds. I'll see how far I get through all of them. I need to think about this also. If we need all these questions, I'll think about it today. But they are, I mean, it's stuff we've seen before, right? And it's things that's definitely going to be on the final exam. So it's necessary, but it might take us a bit of time. So I'm going to see, what makes sense. But this is what I'll go through to try and get you guys situated for the final, and that's Tuesday. Any questions about Tuesday?
So should I wait with starting with it?
You can start, because I mean,
That you might take some questions off, no?
No, oh yeah, I don't know, because all of them are, all of them are topics that you guys need to review. With the exam itself may not have every single thing in it, but I need to look at them and see, because some of these questions, although like it looks, like a lot, do you see, it's just like two journal entries. So what I mean by I need to think about it is I know which questions are long, but I also know that some of them are going to be like super short. So, look. So it might look crazy, but we can probably get through most of it. My thinking about it is just how much of this I can get through to help you guys, right? That's the point. So it's not necessarily, I don't think I'm going to take anything off. I need to think about this. Let me think. All right, but if I were you, I would start with 13 problem. I'm not going to take off the first question. Okay, there's definitely a question in the final that looks like that question. So, you're safe if you want to start with that. Okay.
Professor, can you go over the test in Wiley Plus, not Wiley Plus, in Blackboard? You add examples, questions for the test. You know what I'm talking about? The test information. In the test information, you said like question 1 is very similar to this question. This. Can you show what does it mean, the E and BE and the P?
And E is exercise, BE is brief exercise, and P is problem.
So what is from the homework?
Can we do this at the end or at another time? Because I think this is something that is going to take time away from chapter 18, and I really do need to finish this. Or you can email me and ask me if I need to clarify something. All right, but I can't do that now, because that's probably going to take like 10 minutes, and I'm pushed for time. All right, so ask me again, or in the office hours when you come, ask me again, and if there's something I need to clarify, I'll clarify it to the whole class via email. Okay, thanks for bringing it up. I just can't answer it now. Okay, so last time when we were together, going into chapter 18 now, last time when we were together, we did a profitability, went through all the profitability ratios, and there were many of them. You may, recall they start with profit margin, and we went right through to payout ratio. The payout ratio being how much, what percentage of net income is being paid out to common stockholders through dividends. So at that point, we did example 5, and we ended up with example 5, we stopped at gross profit rate, which was also the end of the question. Remember, this was the question for bonds and noble. So those who are following on this document, we would have ended with gross profit rate. And we saw that bonds and noble was kind of deteriorating from 2021 to 2022, although we're not yet in 2022. So I think all of the stuff is probably hypothetical. But the point was, I showed you with some of these ratios that you could actually calculate them for more than 1 year. Like profit margin, we calculated for 2 years, and you can see whether there's an improvement or a decline, and that we refer to as intra-company within the company, intra-company analysis. So what we're going to do now is move on to number 6, example 6. Sutherland Inc. And what this example is doing is covering some of the other profitability ratios that have not been dealt with yet, because number 5 didn't do all of them. And then this one extra ratio here, and I'll talk about this before we do it, times interest earned, is not a profitability ratio. It's actually a solvency ratio. It's about whether the company is capable of paying its interest or not, right? So that one is well, I will just give some preamble before we actually do that calculation. So if you are following on a document or whatever, it's the same document as Tuesday. Just moving to example 6. So here it says the income statement for Sutherland Inc. appears below. So it's the income statement for the year ended December. Net sales 400,000, cost of goods sold 230,000 minus, so net sales minus the cost of goods sold gives you a gross profit of 170,000. There are expenses that they are going to deduct, and they're telling you that within this expense number of 105,000 is 16,000 of interest and 24,000 of income taxes. This will become necessary to know when we calculate this thing called times interest earned, okay? And so the gross profit minus the expenses gives us a net income of $65,000 for the year. Then they also tell us that the weighted average common shares outstanding in this year were 30,000 shares. So we must need this, right, information for one of these, for one of these ratios. And then the market price of Sutherland Inc. stock was $13. So somehow this price stayed the same, for the whole year. Not sure how that happened, but we accept that. Cash dividends of 26,000 were paid, 5,000 of which were to preferred stockholders. So in the end, they're asking us to calculate earnings per share, the price earnings ratio, the payout ratio, and times interest earned. So the way you would approach this question is you'd have the formulas nearby or next to you or whatever, and then you would look for what the formula is requiring you to do and go and find those numbers in the income statement or in the additional information. Okay, so I am going to go here, example 6, and we are looking at earnings per share as the first item to calculate. And if you can't remember what the formula is for earnings per share, you're just going to go right back up here and look around and say, do I remember? Okay, yeah. Net income minus the preferred dividend divided by the weighted average common shares outstanding. So if I remember correctly, most, if not all of those things were given to us in the question. So net income minus any preferred dividend, right? Divided by the weighted average common shares, right? Common shares outstanding. So now you know what the formula is. Now it's just a matter of going to find those numbers in the question, right? So net income is 65,000. The preferred dividend is 5,000. All right, so we have the top two numbers. So it's 65,000 for the net income minus the preferred dividend of 5,000. And now we need to find the weighted average common shares outstanding. So yeah, you don't even need to say beginning plus ending divided by 2. They tell you that for the whole year, the weighted average is 30,000, right? So the denominator in this case is going to be 30,000. Excuse me. And so if you do that calculation, you will see that the earnings per share is $2 per share because it's 60,000 divided by 30,000. So this means that the common stockholders earned $2 of net income for every share they held during the year. That's what that means. Right. And this is a major number, in finance and accounting and so on, because often, like I said before, analysts will actually predict based on what the company, says the projections are for the earnings. Analysts will actually predict what they think a company is going to earn, earnings per share. And and often there's what they call a consensus estimate. So analysts from different companies, whether it be Reuters, Bloomberg, you name it, all the different finance companies, they'll have some estimates, and then there'll be a consensus estimate of what we expect earnings per share to be. And if the company beats that expectation, almost immediately the stock price will go up. If the company, makes almost the same amount as what's predicted, everything's fine. But if they miss the expectation, normally the stock price goes down. All right. So it is an important number, and you see the earnings per share on the income statement of these companies. They actually disclose it on the income statement. So it's information that's widely known. Any questions on the calculation of the earnings per share? All right, so B is the price earnings ratio. We spoke about this the last time, right? This is kind of, and we saw for some of the companies, how high it can go. Like we saw for Tesla, this number was almost 400. We're basically saying, right, how much is an investor willing to pay for $1 of future earnings, right? That's what the PE ratio is saying. So I think for Apple and Google, it was somewhere in the $27, $28 arena. So you're saying an investor's willing to pay $28 today for $1 of future earnings. And what that means is this is how many times they'll pay for earnings. It's, the stock price is, an indication of that. So they're willing to pay 28 times earnings just to get one share, basically, of the company. And that's because they think that the company has, if it's a high number, the PE ratio, they think that the company has a lot of potential to do well. So price earnings ratio, again, if you get stuck with what's the formula, you just go right back up. And this is why I said when you're doing the homework or the test or whatever, make sure that you have these things available so that you're not constantly going, and don't be like me going up and down, right? Just print it out or write it out and have it next to you. So it's the market price per share of stock divided by the earnings per share. And we knew that before, but I'm kind of just refreshing everybody's memory, right? So market price per share divided by the earnings per share. Oops, per share. And in the question, they tell you the market price. And I mean, yeah, it's a little bit weird because they're saying, the price was 13 in 2017. I don't know why the price didn't move at all, but it's also possible to just take the price on the day when you're doing the calculation. So 13 is the number that we have. 13 is the market price. We know that the earnings per share is 2 because we just calculated it above. So we call it 6.5 times, all right? That's how we express it. And what this means is that investors are willing to pay $6.50 today for $1 of future earnings. Because the earnings that you're making is only $2 per share, but you have to pay $13 for one share. That means someone's willing to pay 6.5 times, right, the earnings in order to buy a share, because they believe that the price of the stock is going to go up in the future because they think that earnings will be higher in the future. That's what the PE ratio is saying. So when we saw that Tesla was a PE of 394, that means that people are willing to pay $394 today for $1 of future earnings, right? And depending on how much earnings the company has, that's how, we ended up with a stock price, or we have a stock price. I think it was $1,100 per share for Tesla. So, Tesla's not making that much earnings. So people are willing to pay almost 400 times the earnings in order to get into the stock. questions on PE? This one's a little bit weird concept, right? So that's why I'm explaining it so much. I think the thing you should just walk away with is this number that you see over here. That's how many times people are willing to pay, right, for $1 of, or how many dollars they're willing to pay for $1 of future earnings. Okay, if there aren't any other questions, I'm going to move on to the payouts ratio. And like we said before, the payouts ratio is saying, okay, fine, so you earned all this income, right, net income, but how much of it are you actually paying out to everybody? And for years, you know, this was a big thing with Apple. For years, they didn't pay a dividend. They just refused to pay a dividend. And remember, common stockholders are not entitled to a dividend. We spoke about this in chapter 14. Preferred stockholders, you know, if it's a cumulative dividend, they have to get their dividend eventually. But common stockholders are not entitled to anything. So I can't walk up, even if I have Apple stock, I can't walk up to Apple and say, hey, I want, you know, a dividend. The only time I'm entitled to a dividend is after it's been declared. So for many years, Apple was making these massive profits, but they weren't paying out any of those profits to stockholders as a dividend. And eventually the stockholders got so mad that I think at one of the annual general meetings, they actually, I mean, I don't want to say that they had like a mini riot or whatever you want to call it, but they kind of went a little bit nuts and said, you know, basically this nonsense with Apple saying that they are just reinvesting the money in the company, which is why they can't pay dividends, has gone too far. And they're basically demanding, you know, they're joining forces and demanding that Apple consider paying a dividend. And I think when the board of directors saw how aggravated everybody was, they finally changed their ways and started paying a dividend. And I mean, I have like, I don't even know, I have a few Apple stocks or one, I can't remember. I bought some portion of Apple stocks on my Robinhood account. And, you know, I get my tiny little dividend at the end of every quarter, but it just reminds me that, you know, not too long ago, they were one of the companies that just refused to pay anything out. So if you're thinking about investing and you not only want capital gains, meaning the stock price is going up, but you also want income, you have to check whether the company is actually paying dividends or not. And if they're not paying dividends and you did want dividend income, you may need to think twice about whether that's the best investment for you. And I'm not trying to promote, you know, investing only in companies that pay dividends. I'm just saying you have to look at your own needs. So the payout ratio, again, looking at the formula, all formula driven, like we were talking about before. It's cash dividends, but it's the cash dividends only on the common stock, not on, you know, on everything, because preferred stock, remember, their dividend is set. So we're less concerned with them. So cash dividends are 26,000, but 5,000 of that belongs to preferred stock. So we have to keep that in mind. So it's the cash dividends, and I'll put in brackets here for common stock, right? What's going on with my spelling today? Divided by the net income. All right, so 26,000 minus the 5,000 of the preferred, and then the net income is still the same, 65,000 as before. So you're basically saying 21,000, right, divided by 65,000. What is that? So that comes out to some weird looking number. And the ratio, the payout ratio is expressed as a percentage. So we need to express this as a percentage. And remember, when you're doing the homework in Wiley, you want to make sure that you are following whatever rounding convention they're telling you to follow. So often the question will tell you, in red, round to 2 decimals or round to 1 decimal, whatever, please do that. Otherwise, you could spend ages trying to see why your answer is wrong. And meanwhile, your answer is correct, but you just didn't round to the appropriate number of decimals. Okay. Remember that it's a computer marking your work. So the computer is not like, you know, a person that will be like, oh, they just didn't follow the instructions. Fine. I can see in the intervening calculation that what they're doing is fine. It's looking for the actual number. So, you know, that can be frustrating, I know, but please just follow instructions, which is, I guess, a life lesson. Okay, she is saying that she didn't round some of the stuff and it accepts it, but if you just make sure that that's, I don't know that that applies across the board, just read the instructions. I've had, for this chapter, I've had people, not this class, obviously, because you guys are so busy, but in the past, people emailing me to complain that their answers weren't being accepted. Okay, so what does this mean? 32% the company paid out approximately 32% of net income in the form of dividends to common stockholders. So is that good, bad, ugly? We don't know. It, you know, it depends on what happened in the past. I mean, 32% sounds pretty decent to me. But again, it will depend on what was the percentage last year. Was it the same? You know, was it much higher last year and this year it's lower? You know, does the company need to hold some money back? Is something else going on? We don't know. But the point here for me with you is that you understand, you know, what this 32% means, that the dividends are basically 32% of net income for common stockholders. So that means that's what's being paid out to them. Questions? Yeah.
Professor, so up there where you were solving it, you wrote 26,000 minus 5,000. So those 5,000 you said are the preferred
Yeah,
stock?
yeah, it's the preferred dividend. Thanks for asking in case someone's not following it. That's given in the question. Yeah, look, of which 5,000 were to preferred stockholders.
Okay, thank you, Professor.
Yeah, okay. What else? Anything else, anybody? Okay, so let's go to solvency ratios, because the loss ratio in this question, times interest earned, is not part of profitability but part of solvency. So I'm just going to do the theory of solvency ratios with you, and then we can come back and calculate times interest earned. Okay, we'll go back up here. All right. So solvency ratios, I said this a few times before when we're kind of doing the beginning of the chapter, that solvency has got to do with whether your assets, total assets, are greater than your total liabilities. That will mean that you're solvent. If you're insolvent, this is another word, another way of almost saying that you're bankrupt, basically. You're insolvent, it means that your liabilities are greater than your assets, and we're talking total, not current. Total liabilities are greater than total assets. So it means that even if you had to liquidate every single asset that you own, you would not be able to pay off all your liabilities. So that's when people end up like in bankruptcy court and stuff, where they end up paying their creditors, you know, 25 cents on the dollar or however many, you know, pennies on the dollar, because they actually don't have enough assets to cover all their debt. So you can imagine that someone deciding to loan money to a company, or someone thinking about investing in the stocks of a company, is going to be, or the bonds or whatever, is going to be especially concerned about whether the company will be able to pay its debts in the long term. So, you know, remember with liquidity analysis, we were looking at short-term liabilities, current liabilities, and so on. Here we're talking about, can the company survive over a long period of time? right? So maybe a company's current ratio is not too bad. Things are looking okay. They have some current assets to cover their current liabilities. But when you look at total liabilities, you suddenly start to realize that they don't have enough assets to cover that. So long-term creditors, so let's say a mortgage lender or notes payable that is going to be outstanding for 5 years or something like that. Those people are concerned with, what's your prospects going into the future, not just, for the next year. So long-term creditors, and like I said, and stockholders, because remember, when there's a liquidation of a company, the first people to get paid are the creditors, right? If you think about the accounting equation, assets equal liabilities, right? Plus stockholders, equity. If you look at the order that these are written in, it's also the order that people get paid. So if the company gets liquidated, the liabilities will always be paid first. And the stockholders' equity, sorry, there's a typo here. And the stockholders' equity, meaning I'm talking about common stockholders, right? I mean, preferred stockholders are even before the common stockholders, but stockholders are going to basically be last in line to get anything that's left, right? A residual that's left over. So if you are a stockholder in a company, you absolutely are concerned with how much debt the company is carrying, because you know that that debt has to be paid off before you receive anything, right? Or the interest on the debt has to be paid as part of, the expenses of the company. So that also eats into the amount of net income that's left over for you to be able to get a dividend. So the stockholders are always kind of residual, waiting at the end to see what's left over. So they all are long-term creditors. Stockholders are interested in the company's ability to pay interest as it comes due, and also to repay. We've had this before in chapter 15, face value of the debt at maturity. The face value is just the actual amount that's owed, right? So if a company decides to suddenly issue bonds payable, and I'm a stockholder in that company, I'm going to be concerned with, hey, what will this company be able to pay back this bond, or am I going to end up in a situation where my stock is going to be worthless because they end up defaulting on their debt or something like that. So two ways in which we will look at solvency, two ratios. One is measuring the company's debt, so the total liabilities to the total assets, to see, right, what is the debt as a percentage of all the assets that the company has. And obviously you don't want the debt to be too high a percentage, because that's telling you how much of the assets are financed. And I mean, you can think about this in your own life as well, right? How much credit card debt are you carrying? How much of that was paid for things that you for things that you own? How much of your assets are actually financed through debt, and how much are financed just through the actual, cash that you're earning doing your job? It's a similar thought process, right? For us, for me, we bought a house recently. So if I look at what's left on the mortgage, I'm saying, okay, this is how much I owe the bank. This is how much the house is worth. So, what's the debt to asset ratio? It's very high at this point because we've only been in here for a few months, right? But as we pay down the mortgage, our debt to assets ratio hopefully will get a little bit better. So the debt to asset ratio measures the percentage of the total assets that the creditors provide as opposed to stockholders, right? If it's a house, it's how much do you owe the bank versus how much equity do you already have in the house. It indicates the company's degree of leverage. Leverage means how much borrowing you've done, right? If you say you're levered, it's basically you're using somebody else's money to finance whatever you're trying to do, and provides an indication of the company's ability to withstand losses. The more borrowings you have, the less likely it is that you will survive if you suddenly start making a whole lot of losses. I mean, it's the same in personal life as well, right? The higher your student loan debt, your credit card debt, whatever debt you have outstanding, if you suddenly, God forbid, lose your job or something, it's much more difficult to withstand that type of loss of income than if you actually had savings and you didn't have as much debt. It's the same for companies, all right? So when we look at a company to lend them money or to invest in them, we don't want them to have a ton of debt. There's nothing wrong with having some debt, but not a high percentage of their assets being financed through debt. The higher the percentage of debt to total assets, the greater the risk, right? You get riskier that the company may be unable to meet its maturing obligations. So this is the same for us as individuals. If you think about your credit score, how your credit score is calculated, part of that calculation is how much credit is available to you, right? What's the limits on all your cards and stuff, and how much of that are you actually using, right? What percentage of your available credit are you using? And then if you are trying to loan money from someone, they're looking at these things to see how risky, right? How risky are you? So when we were looking to get a mortgage for the house, you know, that's not the time for me to go on a wild spending spree on my credit card, because that's impacting, right, the amount of money that I owe. So similar, if you're trying to improve your credit score, you want to lay off using, you know, your cards and going crazy, because the higher the percentage that you use, the worse it is for your credit score. Of course, just be careful. Don't close, you know, your credit card accounts down completely, because then that decreases the amount of credit available to you. We can have a whole other discussion about this, about managing your own credit. But I guess my point is to say that companies also have to manage their own credit so that they can still keep themselves open to being able to access funding if they need it. So the way we calculate debt to total assets ratio is the total liabilities. So that's current and long-term liabilities divided by the total assets. Again, that's current assets and property, plant and equipment and investments and all the other assets that the company has. So it's a very simple, or it should be a simple calculation. You're just looking for total liabilities and total assets. And then this last formula that we will deal with, times interest earned, kind of a weird name and a slightly weird concept, but very important in business. Basically, it's asking, is the company able to pay the interest on the debt? Sorry, but to increase your credit score, you want to have some balance to show you can cover it. What do you mean by some balance? Do you mean balance on your card, like that you actually use in your card?
Yeah.
Yeah, of course you
That's what
should
I've heard,
use.
that
Of
you
course you
want
should.
to,
Yeah, of course you should use your card. Like if you don't use your card, I'm not advocating that you don't use your card, because if you don't use your card, it could even become like what do you call it? I'm losing the word now, but it's almost like the company will end up closing it because it's inactive. That's what I'm trying to say. So your best bet is to charge something and pay it off, you know, immediately or as soon as possible. Definitely use your cards, but I'm saying don't, if your total credit available is $15,000, you're going to have negative impact on your credit score once you start. I think it's like maybe over 10% use, it starts, you know, counting against you. Like if your balance on the card is, or on the cards plural together, is more than a certain percentage of the total available, then it's going to start, you know, messing with your credit score. I've seen this happen to me. I mean, not to get too detailed, but depending on which you know, facility you use to report your credit score, they pull your numbers at different times of the month. So sometimes I've had them pull the number after I've already paid off my card, and sometimes they pull the number before I paid it off. And depending on what the balance is I have on the card, it does change my credit score, sometimes by as many as 10 points. So, you know, if you are going up for some borrowing that you need to do, just observe your credit score over a few months and see what might impact it. There are more things that impact it. The length of time that you've had a card for. So never ever close the oldest card that you have. I have a terrible Citibank card with like almost no rewards, and it's basically semi-useless, but I keep it open because it's the card that I opened when I first arrived in the country, right? And the longer you've had credit, the better it is for you. Closing a credit card will also impact you negatively. Your score will go down. But if you feel like you're really not using this card ever and it's a problem, then do the closing at a time when you don't need to report your credit score, you know, for anything. And like I said, we could go on forever, but yes, use your cards, but don't carry balances to the point that you know, it's, if you are trying to improve your credit score, carrying large balances on the card will work against you. And you can see what they say on your accounts, right? It says if you only pay the minimum, it's going to take you so many years to pay off the card because you're paying interest, as we know. So yeah, when we in the spring or in the fall, when we reinvigorate the finance club, we can go to town on all these discussions. It's so important. And you know, when I was sitting where you guys are sitting, nobody told me anything. Nobody. So it's important that you find the stuff out or talk to me if you have questions. All right, so times interest earned, right? What's going on with that? It's basically saying how many times over can you pay your interest, you know, with it's basically with some portion of your income. The bank is trying to say, hey, you know, we know that if we lend you this money, it's not just the final balance that you have to pay off. You also have to be able to pay the interest in, you know, the intervening months before the maturity date. And based on the income that you're making, how many times can you cover that interest? Because we want you to be able to cover that interest as much as possible. This doesn't mean that you have to pay the interest, you know, so many times over. You just pay one interest payment, but they're trying to see, like, you know, if I make income and my income is the same amount as the interest I have to pay, then I can only cover my interest one time over. And to a bank, that's very dangerous, because it's saying if there's any change in your income, you won't be able to pay your interest. If I can show the bank that I make 5 times the, you know, the interest amount, or 10 times the interest amount, they'll be much more likely to give me money, because they know that they'll be able to get their interest, right? Everybody is just concerned with, you know, if they want to give you money and stuff, they're concerned with whether they'll be able to get that money back. So how does this ratio run? Times interest earned. You're going to look at your income before income taxes and interest expense. And this is because interest can't be in the same calculation that you're trying to see whether you can pay the interest, okay? So you don't include the interest, and income tax is taken out because interest expense is deductible. So it impacts your income tax, and they don't want to include that in the calculation as well. So you take your income before income taxes and before the interest expense, and you divide it by the interest expense, because again, you're trying to see how many times over can your income cover the interest that you have to pay. And again, we want the number to be as high as possible. This is all about risk, okay? The bank wants to make sure that you are not a bad risk. Sorry, I didn't ask if anybody needs me to explain something again, or if you have questions. Wait, there's something here. Yeah, still learning. Yeah, still learning about credit. It's sad that we don't have more discussions about this in general. Any questions about times interest earned before I do the calculation for you or with you? No. Okay. So let's do example 6, part D, the times interest earned calculation quickly. So it's your income before income tax and interest expense, right? So it's a long thing, divided by the interest expense. And I think I should have put this in its own, just 1 second. Let me put it in its own cell. All right. So that's again, the formula you don't have to memorize, but you do need to know how to use it, right? So we're looking for an income, a net income number basically, but without having deducted interest expense or income tax. And so I'll go and show you now how to look for that on this thing. So we know that net income is 65,000. But that's after we already deducted interest expense and income tax expense. So what we need to do is add these back. So I'll repeat, net income is 65,000 after we deducted all the expenses. And in that expense number is 16,000 of interest expense and 24,000 of income tax expense. So the way to get income before interest and before income tax is to take the 65,000 and add back the 16,000 and also add back the 24,000. So that's what we'll do now. So 65,000, your net income, plus the 16,000 of interest, plus the 24,000 of income tax. It doesn't matter which order you put it in because it's all addition, okay? So I could have probably put the 24,000 first, but it's not going to change the answer. And you're dividing that by the interest expense number. That's 16,000. All right. And so I will just do the math here. So 65,000 plus 16,000 plus 24,000 divided by 16,000. So 6.56 is the answer. And this is also expressed as times, okay? So that's, I'm giving you a minute to just look at the calculation. Okay, so income before income tax and tax and interest expense can cover our interest expense approximately 6.5 times, right? So we want this number to be as high as possible to show a bank that we are able to easily pay the interest on debt. So a bank will say, okay, so with what you're making, you only need to pay 16,000 of interest, but you're actually able to pay that number 6.56 times over. So probably we feel confident that you would be able to make your interest payment. That's the point. Sorry, that's the point of of this whole calculation is, you know, for someone who is loaning you the money to actually see that you are able to pay your debts. Questions, anybody?
Can I get a few more seconds to copy that?
Yeah, you have time. Take your time.
I'm done.
Any other questions or comments here, people, about times interest earned? Okay, it looks like we're in decent shape. So what I'm going to do here for this the last ratio that we haven't calculated together yet, which is the debt, right? The debt to total assets or debt to assets ratio. There isn't a question that is only calculating that specifically, but this example 7 does have debt to assets as part of the question, right? Calculating debt to assets as part of the question. So, and again, I don't know why all the formatting dropped off, but you know, this is a total column supposed to be here, and this is also a total column. So I'm just fixing this so we can see these numbers properly. Okay, so I'm not going to calculate every single ratio again with you because we've been through all of them and all the answers are going to be available to you. But what I do want to do is calculate the debt to assets ratio. And then after I do that, we'll take a break. And when we come back, I'll just talk about sustainable income and do an example of that with you. And then with any time we have left over, we can come back and do some more practice of the ratios. All right. So again, debt to assets ratio is the only one of these. I'm picking this out to specifically calculate for example 7. So just looking at example 7, I took it out of the textbook. You can see the yellow here. I think it was one of the practice examples. So it says Rondo Corporation's comparative balance sheets are presented here. Remember, comparative just means 1 year in comparison to another. So they've got 2021 and 2022, all the current and long-term assets, accumulated depreciation, and so on. Total assets for 2022, 110,500. And then they've got liabilities and stockholders' equity. They weirdly only have this one liability, accounts payable. They don't have any other liabilities. Then there's common stock and retained earnings. That's obviously part of stockholders' equity. And there's the total again, 110,500, because remember, the balance sheet needs to balance. All the assets equal the liabilities plus stockholders' equity. They also tell you some stuff that we probably won't need for the debt to assets ratio, but I'll just read it. Rondo's 2022 income statement included net sales of 120,000, cost of goods sold of 70,000, and net income of 14,000. So that's a lot of this is going to feature in the profitability ratios, but I'm going to skip over and just go to debt to assets ratio and show you for this example how to do the ratio. So example 7, and specifically debt to assets ratio. And it's going back to what we saw in the page, right? It's just the total debt divided by the total assets. That's it. And by total, I really mean total, although of course, because this example is maybe not the greatest, they only have one item of debt. They only have one liability. So total debt divided by total assets. All right. So be careful here. Sometimes people make a mistake and think that total debt means that you take this ending number. That's not correct, because this also includes equity. You only want to look at liabilities. And in this case, they only have the one, right? The one liability, accounts payable for $10,370. So my total debt for this question is just $10,370. And the total assets, slow me down if I'm going too fast. I feel like I'm talking too fast. I can slow down. Okay, so total debt is just the accounts payable. Total assets, you're looking over here, okay? Because all these items are assets. All of them, including accumulated depreciation, that's a contra asset that also gets thrown into the total assets category. So that means that the total assets is going to be 110,500, right? So it's cash, accounts receivable, etc., etc. Again, don't exclude accumulated depreciation. It's still part of total assets. So 110,500 is the total assets. So what do we get, right? 10,370 divided by 110,500. So we've also again got some weird number. This needs to be expressed as a percentage. So they don't have much debt. So this is not a company that's in grave danger of anything going wrong, because you can see the number is like 9.38 or 9.4%. That's their debt to assets ratio. So what does this mean, right? 9.4 cents of every dollar of assets that the company owns is financed with debt. That's what that means. So that's I mean, even just looking at it on its own without comparing to previous years or anything, that looks pretty decent. That's not a big percentage of the company's debt that is, or of the company's assets, excuse me, that's financed through debt. I'll give you a minute to simmer and see if you have any questions for me about this. Okay, so I'll leave it there and we can take a break. I'll leave the answer up still. So 11, let's just say 11:45, okay, even 11:45, you come back and we will look at that point, at the part of this chapter that deals with sustainable income as we round the corner here to finish our work for this chapter. And Jahome, you wanted to ask me something during the break. You're welcome to, if you're around.
All right.
I'll just make you a call. Are you okay to share your screen? I can stop the recording if you want to.
Oh, yeah. No, I don't mind at all.
Okay.
Whatever is needed. Hold on one moment.
I'll just pause the recording because I don't think it's really necessary to record this, but you can certainly really helpful. plus 10 generous points of of just good vibes sent out to you for doing that. Thank you. Okay, so sustainable income, the most likely level of income to be obtained by the company in the future. So again, when we invest, when we loan money to someone, when your sister, brother, whoever, niece, nephew comes knocking on your door and says, I need $200, you're not just going to say, yeah, here's the money. You're going to say, what's your ability to pay that back? When are you going to pay it back? Are you employed? Are you not employed? What are you using the money for, etc. So this is the same idea, right? Will the company be able to make money in the future? It differs from actual net income by the amount of unusual revenues, expenses, gains, and losses, and so on included in the current year's income. So, your family member may say, I really need this money because I unexpectedly wasn't able to work 3 shifts this week. Something happened, at work and they didn't have us in, but next week I'll be able to work and I can pay you back or whatever. So that's an unusual situation, something that came up that is maybe, this person is generally good with whatever they do, but this is an unusual situation. Whereas if it's someone like, I skipped work and they've been doing that for a while and they're not really, that focused or whatever, you might think twice about giving them, a loan. So it's the same here with companies, right? If there's some unusual stuff going on, maybe they have big losses in one year for some reason. COVID is a big example of companies, maybe sustaining extreme losses or expenses and things because of the pandemic. When companies are looking at loaning money, granted we're still in the midst of the pandemic, but they may also be realizing that, should this company emerge from the pandemic, they're not going to have these extreme expenses all the time. So it's important to separate out what is unusual from what is sustained or normal, carrying on, year to year. An income statement provides information sustainable income by separating operating transactions from non-operating transactions. Operating means everything that's happening day to day. It's the normal daily, occurrences. Non-operating are, all those other gains and losses and, other things that are taking place. We'll also see something called discontinued operations later on. So again, we're analyzing financial statements, right? That's the purpose of the whole chapter. And in this case, we're looking at, what's the company's earnings potential outside of any unusual stuff that may be going on. And I mean, again, in real life, we do the same when people are asking us for money or something. We're saying, what's your potential to pay me back outside of what's just happened now, causing you to borrow money from me? So other vocabulary stuff here, financial statement components that we haven't dealt with before, comprehensive income and the statement of comprehensive income. The word comprehensive means, it's everything included. So this is an additional, I guess, I don't want to call it the financial statement, but a part of the financial statements that shows some extra items that don't come up in the income statement, right? So that it's getting shown elsewhere outside of the income statement. Comprehensive income is part of stockholders' equity. So these things that go into comprehensive income bypass, they don't go through the income statement and they go straight into stockholders' equity. So as it says, the income statement reports most revenues, gains, expenses, and losses. There are, however, some items which bypass the income statement and go into stockholders' equity, other comprehensive income items. Companies are therefore reported to not only, or required to not only report income statement, but also comprehensive income items. And a comprehensive statement sometimes starts with net income and then it includes the other things. Everything to do with financial statements is about being, as I guess, stating things in a way that is not going to be harmful to investors, whether they be debt or equity investors, and being as, transparent as possible. So this comprehensive income statement is, picking up things that people would maybe expect to go through the income statement, but they don't, and making sure that they have an opportunity to see them in this statement. All right. And then I'll go through this and then I'll take questions or comments. The last piece here that we need to be thinking about is discontinued operations. And I'm sure some of this happened with companies now in the pandemic, right? They decide to stop operating a portion of their business and they dispose of it. So some significant component or segment of the business is disposed of, and there will be income or loss, right, from the discontinued operations. And it comes in two parts, right? There's the income or loss from the actual business up to the point that it was stopped. And then there's also any gain or loss when you sell the business. So all the assets that you're selling off and so on, there might be gains or losses on that. So if you think about a company that, maybe they sell off, it's a bakery and they discontinue the restaurant portion of the bakery. So up to the point of the discontinuation, they would have made some income or loss on the restaurant. Then once they discontinue it, they may sell all the kitchen supplies, all the equipment from the kitchen and so on to another restaurant. And so there might be gains and losses on the sale of all of those assets. And the discontinued operations will be shown in the income statement and not in the comprehensive, in the statement of comprehensive income. So that was a lot of information. I'm going to let it simmer here for a minute or two, see if anybody has questions or if you need me to repeat something before we do any examples. All right, so what are we gonna do? We will do one income statement where there's also discontinued operations, and I'll show you how to do that. We will also build a statement of comprehensive income so that you guys are familiar with that. You also have additional opportunity to practice that as part of the homework. All right. And again, if you're thinking about what's the point of doing all of this, curious minds want to know, bankers want to know, investors want to know what part of the company's business is sustainable into the future, and what part is, either gain or loss or whatever because of something unusual that has happened in the current year. So I'm looking at example 8. And this is also an example from the textbook, so you may run into it again. The numbers are different, but the thought process is the same. So example 8, in its proposed 2017 income statement, Rabeck Corporation reports income before income taxes of $500,000. So yeah, you have to stretch your mind back to chapter 14's work, if that's even possible right at this point. Chapter 14's work where you built income statements. So, you started with sales, less costs of goods sold, minus any operating expenses, and maybe you had other revenues or other expenses, other gains, other losses, and eventually you come to income before income taxes, right? That's near the end of the income statement. And then you would have deducted income tax expense and then get to net income. All right. But because we now have this new thing called a discontinued operation, we will still be making some additional changes. So income before income taxes of 500,000, income taxes of 100,000, not including unusual items. So what this means is that the income tax impact of these unusual items, like the discontinued operations, hasn't been accounted for in the 100,000. So we need to account for them when we actually calculate the gains and losses from discontinued operations. I'll show you how to do it. Loss on operation of discontinued music division, 60,000. So that means that the actual operations, right, of that music division, unfortunately resulted in a loss of 60,000 up to the point when it was discontinued. There is, however, a gain on the disposal of the discontinued music division, probably selling off all their instruments or whatever it is that they had in that division, and they ended up making a gain of 40,000. So this loss is from operations, 60,000. The gain is from selling all the stuff after the music division was discontinued. And then they say they have an unrealized loss on available for sale securities. So this one's a little bit tricky because our syllabus doesn't include chapter 16, which is about investments, but we are being faced with this number. What I'll just tell you is that this unrealized loss is going to be part of the statement of comprehensive income. That's all you need to know. Just put the unrealized loss or the unrealized gain on available for sale securities in the statement of comprehensive income. The income tax rate is 20%. Prepare a correct statement of comprehensive income, beginning with income before income taxes. I feel like I'm missing a part of this because I'm also supposed to prepare an income statement. I'm not sure if I accidentally did something wrong here. Let me see. Let me just say, I'm just going to change this. If you have the document, you can make this change also. Prepare the income statement. First is the income statement, and then it's the statement of comprehensive income. So I'm not sure. I may have either deleted something by accident or not copied something properly, but I'm going to start with an income statement and then I'll do the statement of comprehensive income. So this is example 8. Oh, and I need to get rid of the stuff that I did at the bottom here. So in example 8, we have the company name. Remember, we're doing financial statements. So company name, the name of the financial statement. And they'll also always say that it's, partial or whatever. And an income statement is for the year ended, right? We know that. It's for a period of time. Well, I don't know if was it 2017? I think so. All right. So income before income taxes, that's going to be the first line that I'm dealing with. And if I go back to the question, I seem to have lost some of my stuff here. What happened? Yeah, I don't know what happened, but if I go back to the question, I know that income before income taxes is 500,000. So that's where I'll start. And then I'm going to deduct the income tax expense from that 100,000. Okay, I'll give you some time again. I don't know who's writing down with me or who's asleep or who's awake, but I'll give you a minute here to just catch up. We're doing an income statement. We've done this before, but this income statement specifically has discontinued operations in it. So I want to make sure that you are with me, because after I do income from continuing operations here, I will be doing something new, which we did not see in chapter 14. Right, so that would normally be, your really your net income line here, even if you were in chapter 14, but we say income from continuing operations because the next line is going to be those discontinued operations that we just discussed, specifically the music division that the company was discontinuing. So I don't know, for some reason I now have to toggle between even more tabs, but the loss of 60,000 on the operations and the gain of 40,000 on disposal, right? Those are the two things that we will have to deal with. So the way we do it here is we just write that loss from operations of the music division. And this is where things may become even trickier. I don't want to say a little bit tricky, but we have to show that there is tax that is saved as a result of making a loss. Just think about taxes, right? The more income you have, the more tax you pay. So a loss is actually going to decrease the amount of tax that you have to pay. This 60,000 of loss that we see in the question is before tax, right? And I know it's before tax because when I read the question, it said that the income tax amount is not including any unusual items, and a discontinued operation is considered an unusual item. So the 60,000 we show here is before we have considered the benefit of tax savings, right, from the loss. So I'll show you basically the way we write it is music division net of $12,000 income tax savings. And the $12,000 is the 60,000 times 20%. In the question, they told us that taxes were 20%. So the loss, and I know the question doesn't do this, or the answer doesn't do this, but I'm going to do it. The loss becomes less negative, if you could put it that way, right? Let me just try and fix this without the dollar sign. I seem to not be able to. Financial, okay. So instead of a $60,000 loss, you're actually only picking up $48,000 because 12,000 is the savings for tax. I'm going to stop there and check if someone has questions or if you want me to explain it again.
So out of 60,000, that this company will have to pay for.
Or you got cut off. Out of 60,000, the company will have to pay 48,000. I think that's what you're, or they have to recognize 48,000 because they'll get a benefit from the IRS, like a reduction in their taxes of 12,000 because they made that loss. So it's not so much what's paid, it's this loss is just coming from general day-to-day business. So revenue minus expenses ended up in a loss of 60,000, and that loss will also give them a $12,000 tax break. It's probably the best way to say it. So in the end, the loss that they have to recognize is only 48,000 because the impact of taxes wasn't taken into consideration here. So it needs to be taken into consideration over here.
Okay, thank you, Professor. So, question, why is it in a bracket? I mean, does that not mean that we subtract?
Sorry,
When
why is what? I didn't hear the piece there. Why is what at the beginning you said?
Why is 48,000 in a bracket?
Yeah, because it's a loss. So I'm trying to show that it's a negative number that's become less negative because of the tax break. It should,
Okay,
it's really a $60,000 loss, right? But
Right.
because we get a 12,000 tax break, we end up showing only 48,000.
okay,
And I'm
Thank you.
showing it minus because the next thing is a gain. And if I show them both as positive, even though the answer does that for some reason, I think it's a little bit confusing. The next thing is a gain, which I want to show as a positive number. Okay.
Okay. Thank you, Professor.
Other questions, folks? Okay, so to my point about the gain, right? There's a gain on the disposal of the music division, which again is 40,000, but before the impact of tax. So of course, a gain is going to cost you something. Like the IRS is going to charge you tax on that, right? So there's also a tax impact that we will take into consideration. So there's a gain from disposal of the music division, net of, now it's not tax savings, it's $8,000 in income taxes. And where does this 8,000 come from? It's the 40,000 gain times the 20% tax rate. All right. And now when you think about how this works, it's 40,000 positive, but we have to pay tax on this. So the tax is a minus. So in the end, the amount of the gain that we're actually going to show is only 32,000 because we have to take off the tax that we're going to pay from the gain. Please think about this carefully, sit and think about it maybe for 30 seconds or something. A gain is going to cost you tax. So your gain gets smaller because you're paying over the tax, right? A loss is going to save you tax. So your loss also gets smaller, but it's less negative, but that's because you get a tax break or a tax savings on the loss. So weirdly, both numbers end up being smaller. Yeah, you can multiply by 80 or you can subtract 20%. Either way is fine. Multiply by 80 is faster, but if you're being asked to show the calculation, that's how it will look. Good. Other questions? Okay, so what do we do now? That's kind of it. So we just draw a line here and, subtotal these two, the 48 and the 32. They come out to negative 16. The negative 16 is going to be subtracted from your income from continuing operations so that your net income is going to be 384,000. So that's an income statement with an unusual item, specifically being a discontinued operation, right? With a loss from operations and a gain from the disposal. Sorry, I didn't realize I had a typo here. A gain from the disposal of the discontinued operations. So I'm not done, sadly. I still have to do a statement of comprehensive income. Okay, so I'll show you how to do that. But first, I'll give you guys like a minute to just simmer and write down anything or take pictures or do whatever you need to do. There is a question like this in the homework. So I need to make sure that I'm not moving too fast over this. It's, will there be something like this in the exam? I have to look at what I've said was on the exam. I can't remember, but I'll go over what's on the exam on Tuesday. But remember, you could also have a multiple choice question of something like this, even if it's not a am I going crazy? Even if it's not an exercise, you could have multiple choice. I don't know what you mean by is the homework up yet, or you're not seeing the homework for chapter 18 or something? Because other people are doing the homework, so I don't know what you mean by is the homework up yet. John, you're asking me something about the homework being up. Oh, tell me at the end if you don't want to tell me now. I don't understand the question. So tell me at the end. All right, so it doesn't look like there are other content questions with this. So we are also being asked to prepare a correct statement of comprehensive income beginning with income before income taxes. So I will show you how to do that. Although, something is wrong with, I don't know what is going on here. I suspect I must have done like a combination of 2 editions of the book, because I'm not going to start the statement of comprehensive income with income before income taxes, because we've already done an income statement right up to net income. I'm going to start it with net income. So I will put a revised question sheet up for you guys after class and just highlight the things that that I've added here. It must have been a dark time of the night when I'm setting this up, because I don't know what I did here. So forgive me. We'll start with net income, all right, not with and if you did have to start with income before income taxes, you would just add another line onto the statement of comprehensive income. But let's just stick with a plan and go with starting with net income, all right, not with income before income taxes. Sorry for the confusion. I know this work is already confusing enough, so I don't know why I added to everybody's confusion by doing that. So here's the statement of comprehensive income. You'll be amazed by how quick it will be. It will sound much more dramatic than it actually is. So we have name of the company, the statement. It's for a period of time. It basically follows on from the income statement, all right? So the first line is going to be net income. So you're literally taking it from the income statement, okay? Give you a minute to catch up. Okay, so net income. And then we have a heading called other comprehensive income. So if you're starting to panic about whether you'll be able to remember all the stuff, remember that you can keep a template somewhere near you. If something like this does come up on the test or whatever on the final, you don't have to fly blind. And the only thing that's going to go in here now, right, if I go back to the question, the only thing that we haven't dealt with is this unrealized loss on available for sale securities, right? That's the that's the main thing that hasn't been taken care of, because it doesn't belong in the income statement. It belongs in the statement of comprehensive income. So this is the amount that we will put into that statement now, right? So it's an unrealized loss. Basically, this is stocks that the company, or well, it's available for sale. So it's probably debt investments that the company has that they haven't sold, but they have made a loss on it based on the changes in the price of the investment. Okay, if you don't know what I just said, just ignore me, because you don't really need to know what it is in order to put it into the statement. But I feel like for those who are curious, I'm just telling you that it's losses on investments that the company has made. So let me stop here. Remember, all of these things have not been taken into consideration in the income tax expense. So we have a loss of 150,000, but we are also going to have tax savings on it, just like we had tax savings over here. So it's a 20% tax rate. So 150,000 times 20% is a $30,000, right? Net of $30,000 income tax savings. And how did I get that? It's 150,000 times 20%. So again, this is a loss. So the way this looks is you've got 150,000 in losses. You've got a $30,000 tax savings. So it must mean that what's remaining of the loss is 120,000. So the book will probably put this number in just as a positive, because they say it's already shown, you've already said that it's a loss, but I'm just going to do that so that we can all remember that this is a subtraction, right, from the net income number. And then you have comprehensive income. And you're done. I mean, after a fairly laborious business, but you're done at that point. 264,000 is the comprehensive income. So I guess the takeaway here is that there's a relationship between the statement of comprehensive income and the income statement. The statement of comprehensive income basically follows on from the income statement to include any items that have bypassed the income statement, but you still want to show those items to the users of the financial statements. Again, I'll let this simmer. And you can ask me questions. I'm available for questioning if there are questions. No, I'm not calling your name. Sorry, I think Sam was asking me. All right, so now you can decide. I'm going to give you a choice. Ooh, right? I will stay here for the next 25 minutes and I will be here to support anybody who wants to do example 9, which is another one of basically the same, right? Where you're doing an income statement and a statement of comprehensive income. All right. I will stay here to support anybody who actually wants to practice this. Otherwise, and I won't take offense if nobody stays, but otherwise, I think we've done a lot. And frankly, you know, I'm sure your brain is probably as blown as mine is. You are welcome to be dismissed. So you can go, or you can stay and do number 9 and then go. It's up to you. I'll be here anyway. If anybody wants to ask me anything else, you can ask me during this time. But for those who are staying, the point of you staying really is if you want to practice another one of these examples, okay? Okay, so I have everybody's attendance already, the people who are not here. John, I had you as absent, but you're late, right? I'm gonna mark you as late. There's Michaela wasn't here today, nor was Denisa, and a few other people I know were definitely not here. Shimon, are you here? No, okay. So everybody else, I have your attendance. Again, you can stay for the next 20 minutes and work on example 9 if you want to, but there's no pressure. If you just want to go in and take 20 minutes of your life back, it's fine by me. No, the final, someone's asking, is the final really everything we did this semester? No, the final is not really everything we did this semester. In fact, the list of things that are on the final is already on Blackboard. It's been on Blackboard for the semester. So I'll try and see if I can't bring it up so that it's the first thing you see. And the test and quiz information, you can see everything that is going to be tested for exercises for the final, John. So please pay great attention to this sheet. I will be going over this sheet in detail on Tuesday, and we'll also be doing some practice questions. Yes, it says that everything is covered because it's a comprehensive exam, but I'm telling you what I'm covering because it's impossible for me to test every single thing. Do you understand, John? Okay, so please pay attention to the sheet. Don't start studying like now you're studying chapter 12 or something, which you don't need to study. Okay, so is there anybody else that needs support on something? Or otherwise, I'll just leave this question up if you guys want to try to practice it, and I can show the solution for anybody who's sticking around. I'll show the solution at 12:45, but I'll take questions on it if people are stuck or something. If you're still here and you need help or you have questions, feel free to speak up. In about 7 or 8 minutes, I'll go over the solution with anybody who's still working through this. Right, if you're still working on the question, just take a picture or make sure you have the important information. I'm just gonna stop the share so that I can pull up the solution quickly. So just take a moment to make sure you have all the info. Okay, I'm just gonna stop the share quickly. So for those who are still doing this question, here's the solution. I'll just go between the question and the solution. I just want to make sure that we end on time. The company has 290,000 income from continuing operations. They also have a gain on discontinuance of their division, but 10,000 is a loss and from operations, and 40,000 is a gain on disposal. There's a 20% tax rate, and then there's an unrealized loss on available for sale securities. So starting with the income statement, income from operations, you should have had 290,000. Right, as the starting number, then you do discontinued operations. There's a loss from operations, right? That's the 10,000 that I was speaking about. But remember, when you have a loss, you get tax savings. So there's 2,000 of tax savings. The 2,000 is 20% of 10,000 loss. So in the end, the loss is only 8,000. They don't put it in parentheses or in brackets, but this is a loss, okay, of 8,000. Then there's a gain from disposal. Remember, the disposal gain was 40,000 before taking tax into consideration. 40,000 times the 20%. So there's a tax charge, income taxes of 8,000. So your gain goes down to only 32,000 because you have to pay 8,000 of tax. Over here, you save 2,000 of tax. So an 8,000 loss and a 32,000 gain gives you a 24,000 gain. Right, overall. So the 290,000 income from continuing operations plus the 24,000 gain gives you net income of 314,000. Questions there? Anybody? All right, and so to move on to the statement of comprehensive income, there's net income of 314,000, which you take straight from the income statement. And then you had this unrealized loss, right? In the question, it speaks about an unrealized loss of 80,000 on available for sale securities. Again, the loss will give you a tax saving. The 20% is a tax rate, so it's a 16,000 tax savings. So your loss gets smaller by 16,000. So 80,000 minus the 16,000 loss. So it's not loss, minus the 16,000 tax. So overall, the loss is only going to be 64,000, excuse me, because you save 16,000 of taxes. So 314,000 net income minus the 64,000 in loss gives you comprehensive income of 250,000. So that's the answer for that question. Anybody have anything they want me to explain further? All right, so we'll end it there. You guys are, if you're still there, you're more than welcome to go. I'll leave this up for another 2 minutes and then I'll end the call.
Thank you, Professor.
You're welcome. Have a good day.
You too. Bye.
Bye.